now, on that note, let's quickly move on to our next guest of the show. We have Aditya Khemka, fund manager at Incred Asset Management, joining us. Aditya, good morning. First of all, I would like to congratulate you because I was going through your healthcare fund and that has outperformed the benchmark in the past 1 year. So, congratulations on that. But how do you see the way ahead for the pharma sector, given that we have some tariff noise on one hand, and on the other hand, we're seeing some pharma companies focusing on obesity drugs for margin expansion?
Hi, good morning. Thanks for the wishes and thanks to your viewers. So coming to the pharma index, I think if you look at the top 40% of the pharma index, it is companies like the unbranded generic companies which focus on the US market for selling reverse engineered products. That's the segment we're not very bullish on, even though those companies did benefit from one-off opportunities in the past 2 years, and they will have some playing GLP-1 as well. Having said that, the problem really lies in the valuations of those companies. The Revlimid was a one-time cash flow over the last 2 years, and even GLP-1 will be a limited time window opportunity in terms of cash flow. So we are not very bullish. Actually, we are fairly concerned on those valuations, and we feel that pharma index will probably not do well if these companies sort of underperform any expectations. Um, the rest of the index, which is the bottom 60% of the index, which includes branded generic pharma companies or API or hospitals and diagnostics, I mean, I think that's where we are most bullish. We feel these are quite secular in terms of their earning growth, and these are fairly reasonably priced. They're not exorbitantly, expensive.
Hmm. Okay. Okay. Aditya, how about the diagnostic space? Because yesterday we saw some good results which came in from Thyrocare. But in comparison, if you look at from a stock perspective, Dr. Lal Path Labs, Krishna Diagnostic, these all the stocks they haven't done so much so far this year.
So we are extremely bullish on the diagnostic space. I think that's one space where we are the most bullish. And
Hmm.
Thyrocare and Krishna Diagnostics are our top picks in the space because we hold both of them in our portfolio. Remember, this is not a buy-sell recommendation. I'm just telling you what we hold in our portfolio. So Thyrocare will continue to do well given that they're doing mid-teen volume growth, right? So in today's market, if you look at across sectors, how many companies are reporting mid-teen volume growth? And given that Thyrocare has been able to do that, it's phenomenal. And that sort of momentum, if it continues, the stock will continue to do very well. Um, Same goes for the Krishna Diagnostics. I think on a low base, the company is growing fast, and the space in which it is a fairly limited competition space with a lot of room for growth. So clearly, Krishna also, may continue to do well if the earnings come in line with our expectations. When it comes to companies like Dr. Lal, Metropolis, etc., the issue that these companies really have is that their TAM is pretty small in terms of the size of the markets in which they are present. And that's really saturated that market in terms of penetration. So, that's why we are not very bullish. And we feel that these large diagnostic chains like Metropolis and Dr. Lal, they will be steady compounders, but they may not give you outsized returns the way a Thyrocare or a Krishna Diagnostics probably could.
Hmm. Okay. Okay. All right. Let's now talk about a little bit about earnings season so far that the companies have reported, Aditya, because from mid 20s earnings growth that we saw from the past 3 decades, now we are back to single digits. So how are you finding valuations at the current juncture?
Yeah, so look, broader market, I would say mid to high single digit earning growth is fairly concerning. If you look at the Nifty's history, the average P/E multiple Nifty has had over the past 25 years is around 18, 19 times. And the earning growth Nifty has had is almost 13, 14% CAGR over the same time. So the PEG ratio, PEG ratio, the PEG ratio of Nifty has been around 1.5. Whereas if you look at this point in time, the PE multiple seems to be close to 22, and the earning growth seems to be like 8, 9%. So the PEG ratio is more like 2.5 times. So that's clearly, something that's a concern. But, as a PMS house at Incred, we do more bottom up, and we sort of focus on companies where valuations are reasonable and where, earning growth is surely in double digits, maybe even in high double digits.
Hmm. Okay. Okay. All right. This is something that we need to watch out for. Also, the earnings season, we're into thick of it. But yes, now there's no sign of deal with the US so far this time, and we already have a deal with the UK FTA that we saw yesterday itself. So, anything that you're watching out for the market, which is pricing on the tariff rates, Aditya?
No, I don't think the markets are pricing in the tariff race, to be honest. I mean, if you look at what I just said in terms of the P/E multiple of the Nifty and the earning growth
Hmm.
and the PEG ratio, right? 2.5 times PEG compared to historical PEG of 1.5. We are clearly not discounting a tariff. I think the market is playing the taco trade. Trump always chickens out trade, and the market is saying that Trump can only talk, he cannot implement tariffs on India. And if the tariffs come through, you may surely see a step down in terms of the market prices of many stocks which may be exposed to that tariffs. And which is where, we are actively avoiding companies that have any material exposure to the United States, both in terms of products and services. Um, so yeah, I mean, we see opportunity in companies which are more focused on domestic market in terms of selling their goods and services in India and maybe neighboring countries, rather than,
Hmm.
advanced markets or regulated markets like the United States or Europe.
Okay, okay. But from a sector perspective, where are you finding comfort in this market, purely from a valuation standpoint?
Yeah, from a valuation standpoint, I think we are very comfortable with healthcare at this point. Healthcare services, to be more precise, diagnostics hospitals, CROs, CMOs. We are very comfortable with NBFC MFI space at this point. The space seems to be clearly bottoming out. We are also quite comfortable with many discretionary consumption names, where there is no volume growth for the past 3, 4 years or single digit volume growth for the past 3, 4 years. And those stocks seems to be completely bitten out and out of flavor. So there is clearly valuation comfort there. But yeah, each of these stories may take time to play out. As and when the volume growth returns, you will see significant returns being yielded by the stocks in these spaces.
Hmm. Okay, okay. And anything that you're finding overvalued at this point of time in this market? Of course, you mentioned that you're quite bullish on the domestic sectors and you're a little cautious on the export oriented. But from a sector specific, anything that you want to point out?
Yeah, so we find the large private banks quite expensive at this point. We find many large NBFCs, quite expensive. We find IT services with the lack of earnings momentum being pretty expensive on a peg basis. We find many large pharma companies, the unbranded pharma companies, the Sun Cipla, Lupins of the world being pretty expensive. Defense stocks, horribly expensive. Railway stocks, again, pretty expensive. And there are many other pockets, anything to do with EVs, renewables, very expensive. So yeah, these are the pockets that we are actively avoiding. We don't find any margin of safety in these pockets.
Hmm. Okay, quite quite a discomfort when it comes to finding value in this market at this time. But Aditya, how about the consumption space? Are you also betting big on the consumption recovery for the second half, at least for the fiscal year?
Yeah, we are. So look, with the seventh pay commission coming into play, we do expect some recovery in the discretionary consumption space, and that is where we find some value today, specifically some QSRs, specifically some auto ancillaries, and some auto OEMs as well. So we are betting on those companies, believing and hoping that discretionary consumption, disposable income will improve over the next 6 to 12 months. And that is where the volume growth will revive, and these stocks will then start doing better than what they're doing right now.
Hmm. Okay. Okay. Aditya, what about the auto space? We have seen some tepid sales figures that has come month on month, and now with the rare earth magnet crisis also, how do you see the auto sector grappling with all of these challenges?
Yeah, look, to our minds, these disruptions of rare earth magnets, etc., these are temporary disruptions. These cannot be permanent issues, and they have not been in the past. We have always had such temporary issues in the past as well. And these are always, in hindsight, these always turn to be a great time to buy these stocks because the earning trajectory and the PE multiple sort of extrapolates the current disruption to eternity. And that never turns out to be the case. These disruptions always get resolved. Sometimes it takes 6 months, sometimes it may take 2 years, but they always get resolved. And once they get resolved, you have your earning growth as well as multiple re-rating, and which is basically the holy grail of investing, where you want to sort of buy into a stock before the earning growth comes through. And once the earning growth comes through, the multiple also goes up. So as an investor, you make maximum amount of returns in such cases.
Hmm. Okay. What about the chemical space, Aditya? How are you finding the specialty chemical space? Because everyone has been betting from a valuations point of view, and of course the inventory destocking as well. So,
Yeah.
are you also finding the space attractive?
Very selectively, to be honest. I think the specialty chemical space, the phrase itself, specialty chemical, is a huge oxymoron. Generally, chemicals are not specialty. They're generally very commoditized products. There are very few chemical chains which are specialty, if at all. And some of these specialty chemical companies do exhibit good value at this point. But a majority of these chemical companies that people believe to be specialty chemical companies are actually just commodity chemical companies, and they will not see the kind of margins or ROEs that they were reporting during the COVID period. Remember, during the COVID period, the largest competitor of these chemical companies, which is the Chinese companies, they were not able to sell chemicals to India because they were under a complete lockdown given the zero COVID policy. So these companies were not able to sort of sell. And in a commodity market, if your largest competitor is absent from the market, you'll obviously sell at higher prices and you'll get higher volumes. That is what we saw from these companies during the COVID period of FY21 to FY23. And to expect those numbers to come back anytime in the near future is a bit of a stretch in our view. So hence, we are extremely cautious on the entire space. But yeah, there are a couple of, or maybe two, three companies which are actually, specialty chemicals, and those companies might continue to do well in the future as well.
Okay, okay. Where do you stand on the new age companies then? If you look at Eternal, it's just in the past 4 days, 21% returns it has given. And, people have been betting on the expansion spree. But from a valuations perspective and a growth perspective, are you still comfortable over there in the food delivery business itself?
So look, stocks like I won't be stock specific here, but companies, the new age platform businesses, we are bullish on them if we see positive cash flow. Many of these new age companies currently don't generate positive cash flow, and we generally stay away from companies that are burning cash. In our view, the value of any asset is the present value of cash flows, and if there is no cash flow, there is no value to the asset. Simple as that. And hence, we do not look at companies that burn cash. Generally, we don't look at. But the companies that do generate cash, and if we see a material thesis behind, the company gaining more market share, improving sales, improving cash flow, and hence having a significant terminal value, these are the companies that we actually like in the new age space. So Eternal may be one of those, which are generating cash flow, and we believe the company can grow significantly fast in the next couple of decades and eventually have a good terminal value.
Okay, okay, all right. All right, with that, we have to let you go, Aditya, but thank you so much for your time and hope that we connect with you soon.
Sure. Thanks for having me.
All right. All right, let's take a quick check of the markets, how they stack up right now. If you look at Sensex and Nifty, both of them have been trending lower. Sensex once again down about 400 points and Nifty still below that 25,000 mark. So yes, we are still in the negative territory. And of course, the much support that came in from the banking index and of course the Nifty IT index too, once again they have fizzled out any of the optimism and they are once again in the negative terrain. But yes, Pharma Index also from its highs trimmed some of its gains. So with about 0.1% gain at this point, Nifty Realty Index also flat with a positive bias. So yes, we've been flip-flopping right now and looks like the negative bias seems to be continuing in today's trading session. And yes, a broader end of the markets, they have deepened the cuts. Small caps now down with about 0.8% and mid caps also with showcasing a cut of about 0.5%. So yes, all in all, we are in a negative setup at this point of time. We'll watch out how the second half pans out in today's trading session. But for that, you need to come to the closing bell, which is at 3:30. So don't forget to tune in then. And we'll be discussing about how the market is developed and what the stocks were in focus. Until then, signing off.